All right, good Sunday evening, humans, and hope everybody's enjoying their Valentine's weekend with their special someone. Um, Try to make this fast, maybe. I'm a little distracted. Sorry, I got something going on my wrist here. Um, so quick kind of macro market update, if you will. Um, I had posted about 2 weeks ago a chart of the NASDAQ High-Low Logic Index on X. And then, hoping it would get better, it had not. Just kind of went bonkers. When we were about here, around 2.4 on the high-low logic index for the NASDAQ, we're speaking just to the NASDAQ at the moment. It becomes a source of cautiousness as it pertains to the market going forward. Uh, the high-low logic index is essentially a measurement of stocks making new highs, how many stocks are making new highs, and how many stocks are making new lows. And the more you have at that top and bottom, the more bifurcated that market has become or is becoming. And this is the highest reading for the NASDAQ in its entire history. It became, more than just cautiousness at that point. It becomes a little like what the, to the extent that, people try to use analogs and they try to use seasonality and they try to use this or that to model and have expectations, going forward so that they can make reasonable capital allocation decisions or even just game plan for what to do if price action does XYZ. When you have something of this dynamic, right, in the high low logic index, suggesting that the market is the most bifurcated in the history of the market, um, yeah, you got to be that much more flexible with future or with game planning, with future allocations and expectations of the market. This is a situation where, like, it's a record, right? I mean, this is an all time. It doesn't. You could go back to the dot-com period. It is not even close to this level here. Now, this was the reading, Friday or Thursday. It's over three now. It's over three. We get concerned as strategists. We get concerned as portfolio managers when we see the high low logic index and the NASDAQ get above two. It's above three. Like something is obviously unprecedented, and I hesitate to use the word wrong, but it's an eye opener. Now, before I start posting these things on socials, nobody even looks at it. Nobody pays attention to the high low logic index until I make you pay attention to it, basically. Um, so I'll give you some of my thoughts that I've shared with Phenom Group members. Now, keep in mind, we're looking at a chart that goes back to 2024, right? And we've seen the level get above two back here, in the October, November, and December time period peaking. This was one of the reasons why going into 2025, I was looking for a first half of the year correction. Lo and behold, that is what we got. We did get a full correction in the first half of that year because the data informs when you get a high-low logic, index reading at these types of levels, the forward 12-month max drawdowns are double digits. And so coming into 2026, look at what we had, right? In the November, December time period, we got above that 2.0 level again. which is why I've been anticipating a first half correction of 2026. Now, look, these signals in the high-low logic index can take many months, sometimes quarters, before they actually result in a full-blown correction, 10% or greater. So this does, I'm only saying that because you shouldn't fear these kinds of situations or conditions in the market, right? A very bifurcated market. Um, because that's all that they are expressing. These are the market conditions. But we should be aware of those market conditions so that we can better game plan to the extent that we can, right? We can maybe hold excess amounts of cash given the history and the signal from the high-low logic index. So, speaking of this signal here and coming into 2026, we issue, as usual, our full year outlook in November of the prior year. We always do our full year outlook reports in November of the calendar year. And so I'll scroll down to where we discussed the high-low logic index. Now, I don't know, I don't recall if it was for the NASDAQ or it might have been the NYSE, but that's what we will look to find. Lots of data here, folks. Fundamentals, stock and ETF picks for the full calendar year, all of that within our full year outlook report. Our quants, what I'm doing privately, how I'm constructing my portfolio, stupidity from the social media elitist, if you will. You get all kinds of demonstrations, examples to basically flush out or debunk myths, if you will. We do a lot of that here at Phenom Group. Okay, so it was the NYSE, and I'll skip to that chart in just a few minutes. But we had a high reading in the NYSE as well. And here is the NYSE high-low logic index. I've got it's 1 year. And so maybe I'll back it up to show, let's do 2 years here. Right? And this is just for, I'm thinking of this calendar year, but either way, I'll give a bigger chart. So 2025, you can see elevated, right? That's the highest in the NYSE's high-low logic index in more than a year. Now, I mentioned that for the NASDAQ, we're looking for elevated readings, 2.0 or greater. Now, in and of itself, because the NASDAQ has a higher concentrated index, whereby some 20 stocks make up about 50% of the index, we want to see if the NYSE high-low logic index confirms what the bifurcation that we're seeing in the NASDAQ, right? Is it just a NASDAQ issue because it is a more concentrated index so far as the weightings are concerned? Or is this something that is also being expressed in a very broad index like the NYSE? And it was, towards the end of last year, November, December timeframe, we can see for the NYSE, it's a move above 1.62, and that is what we got. Here's 1.6, 1.62, 1.65, 1.675. So this is an elevated reading, and it was confirming what we were seeing in the NASDAQ. So we use this signal, we put it into a quant. Blue Kurtic Market Insights does a great amount of quantitative data works and was kind enough to facilitate this particular quant table here for us regarding when the NYSE high-low logic index rises above 1.6 for the first time in at least 6 months. And this is the issue, right? Expecting a correction. So the max drawdown peak to trough over the forward 12-month period, I mean, they're almost all double digits, right? The median, The median drawdown, max drawdown is 19%. The average one is 17%. They have been as small as 5%, 2%, 7%, but there are tons of double digit ones in here, folks. And so, that's how you can help to formulate expectations for a new calendar year or as part of it's one piece of the puzzle when, creating an outlook for the upcoming calendar year, i.e., 2026. So we're going through the first quarter of 2026, and what we're seeing is things are not improving so far as market conditions are concerned. Yes, small caps are working, mid caps are working. Equal weight is outperforming cap weighted S&P 500. But when it comes to, the total number of stocks, we have a lot of stocks making new highs because you do have a lot of cap tiers that are working well. But we also have a lot of stocks making new 52-week lows. And that's how you get a high low. This is one of those charts or stochastics, if you will, that you don't want the chart going higher. But that is what's transpired. And what to kind of put a button on this conversation, if you will, the high-low logic index and the conditions of the market being so bifurcated, the best term to use is to suggest that the markets, not just the NASDAQ, clearly the NYSE, and I would venture to guess if the NYSE's high-low logic index is this high, then the S&P 500 has a similar dynamic. The markets are fragile. They're very, very fragile at this state. Hence, you just have to be aware. You have to be aware. You have to plan accordingly. Be flexible. There's another dynamic at play here that I don't recall ever happening in my 25, 26 years of investing and analytical experience. And the dynamic that we have in play right now, which I believe is contributing to these record level setting high-low logic index, is that where we've had high readings in the past, it's generally a contribution of large cap growth stocks, more of those concentrated at all 52-week highs, and small caps and mid caps comprising most of the 52-week lows. That's not the case this time. And I think for the first time ever, absent a recession or thing, like this is a normal economic business cycle that we are trending. So you essentially have, these kinds of record levels in the high-low logic index also taking place with a unique dynamic. The 52-week highs are mostly mid caps and small caps and the median stock. And the ones that are making the 52-week lows are your large caps and your growth stocks and your top 100 S&P, companies. That's different this time. So we have data to say, hey, when it gets above a certain level, you should be, you should be aware that you're probably going to get a double-digit correction. But if all of these occurrences where the NYSE high-low logic index rises above 1.6% for the first time in 6 months happened with a different construct, right? More small caps and mid caps making 52-week lows, with large caps and growth making 52-week highs, can we even trust this data, even though it's pretty compelling? Because the construct of what's contributing to the high-low logic index at these elevated levels is extremely unique. And so what I walk away, Seth, what would you do in this situation? How how would you game plan for something like this? I would generally just remain open-minded. I have to lean into price more so than what the stochastics and the data for the stochastics historically speak to, because it is different this time. How we got here is completely unique to every other circumstance. How we got here in the NYSE high-low lie is completely unique and different than the other occurrences. So have to be flexible, open-minded, and probably allow price to dictate. Allow price and keep low expect. I always maintain low expectations, so I don't have to care. I like to put my portfolio and my emotional quotient in a place where I can say, I don't care. Market goes down, I don't care. I've got cash. I can deploy. I can buy growth at a value. And that's what you're getting right now when you look at Mag 7, when you look at the S&P 100, when you look at technology, when you look at software, you're getting value. And how can I say that when the narratives are so compelling, so pessimistic, and even outright negative on the Mag 7 and the technology space? Well, I can say that because earnings dictate price. Ultimately, the price is going to catch up to what the earnings deliver. It's always been that way. If you're looking for perfection in the markets, look at earnings trends, because markets always catch up to earnings. Always. There's never been a, because that's what drives markets. It's earnings, nothing else. There's no such thing as the S&P 500 is an inverse correlation to the VIX. That's an imperfect relationship. It works about 85% of the time, which is pretty good, right? It's compelling. It makes people think. VIX down, S&P up. VIX up, S&P down. Again, it's not perfect. What is more perfect? 98% of the time, the S&P 500 follows earnings. Volatility acts as a voting machine intra-quarter, if you will. Even, it can happen through the first half of a year or the back half of a calendar year. But the reason why we get those V-shaped recoveries, and only V-shaped recoveries basically since the great financial crisis. Did you know every single recovery has been a V-shaped recovery since the great financial crisis? It's because earnings growth, because of the Magnificent Seven. Remember, before great financial crisis, we didn't have a Magnificent Seven. Right? We got Google, right? And then the other companies in the information technology era started to show that exponentially growing free cash flow, margins, and obviously revenue and earnings. Every single recovery has been a V-shaped recovery in the market, right? Because those companies contribute so greatly to the earnings pie for the S&P 500. Right? So that's why I say you can have these corrections, even bear markets. We've had 4 bear markets in the last 7, 8 years, folks. Again, never happened before in history. Never. 2018, we had a technical bear market. 2020, we had a textbook bear market. 2022, we had another bear market. In 2025, the 4th bear market in 8 years, a technical bear market in the first half of the year, all V-shaped recoveries. And so that's, what I lean on. I say, okay, do I have enough? Did I set myself up based on our 2026 outlook report? Did I establish, an outlook that warranted a reasonable cash position and predicated on the probabilities that we get a correction in the first half of the year? And indeed I did, 55% cash. And some of it even grew because of all the profitable trading that we do here at Phenom Group throughout the course of the week, month, and quarter. So when I look at earnings, which we did in our Sunday research report, FactSet earnings, and I look at information technology and I'm like, yeah, I'm getting a value, right? It goes up every week. It's gone up through the earnings season, right? We're at the tail end of the earnings season, and the full year 2026 estimates are at their peak. They've been revised every single week for full year 2026 information technology. They've been revised higher every single. We finished calendar year 2025 with a forecast, if you will, of 2026 information technology year over year EPS growth of 28.7. It's more than 2%, 2 percentage points higher than that as of this past Friday. And it has only gone up as the price for XLK is down on the year. That's called multiple compression, of course. On the year, down 3.1%. NASDAQ is down 3% on the year. Technology down 3.1%. So as earnings are going higher, prices coming down, you're getting value. Well, what if the estimates are wrong? Right? What if the tracking model is wrong and Q1 earnings come in light, or what if they don't come in light but they guide down? This is investing, right? This isn't buying a guarantee, right? You plan for that risk, right? Or you allocate capital based on your willingness to take that risk. There's no guarantees. Just how it goes. I think there's a 1% probability. I don't care what you think. I think there's a 1% probability they guide down when they release first quarter results. How do you like them apples? Speaking of a technology stock. So that's where I am. That's my conviction. You don't have to hold the same conviction that I do, but that's my conviction. And speaking of Apple, I was selling all the way up to 280. As a lot of you who follow my videos and maybe follow my posts on X have seen, I posted the exact, 280 sale execution. I've been buying all the way back down. All the way back down. The stock has given up every bit of its post-earnings release gains and is basically back to where it was pre-earnings. It's literally giving you another opportunity. Same fundamentals that they reported, strong and strengthening fundamentals, you can get basically at the same price before it gave you that insight information and quarterly performance. That's not the stuff I'm in the business of passing up on. So earnings are looking even better. And speaking one more, just for the S&P 500 itself also, last week, because FactSet updates the tracker every week, last week, the S&P 500 full year 2026 EPS was tracking, I think, at 14.2. Now it's at 14.4, which is still lower than the 15% at the end of December of 2025. But it's also consistent. This is what analysts do. So I'd be of the opinion we get the Q1 results, assuming all things equal in the economy, we get the Q1 results from technology, from the S&P 500 cohort of companies, and more than likely we're going to be above 15% for the full year estimate. So the S&P 500 is also down on the year. You're getting value there. You're getting multiple compression. We are below 22 times now. We're at 21.9 forward PE for the S&P 500, right? Earnings keep going higher. Estimates for the year have kept going higher, but S&P 500 price is down. That's midterm years, folks. That's what happens in midterm calendar years. We came into this year knowing it's going to be choppy, it's going to be sloppy. Midterm years suck. People need excuses. The fund flows don't. They were scheduled. Fund flows are scheduled. It's not seasonality, midterm year season. There's no such thing as seasonality. Fund flows are on a schedule. to the extent that we did not issue a new S&P 500 price target coming into this year, because it's a midterm year and because those fund flows take a dramatic step back in a midterm calendar year, we said we're going to keep our 6,800 S&P 500 price target through the first quarter, right? Let the market outperform our expectations. Good, fine, great. We want to be thoughtful with our price target offerings. We don't want to be like every other Wall Street, if not off Wall Street analyst and strategist, who feels that they're just compelled to issue one because it's a new calendar year. No, we said we're going to keep that in place. We want to see what the January barometer brings. We want to see the close of the toy barometer period. Then we'll feel more comfortable issuing a new 12-month forward S&P 500 price target. And that's exactly what we did. Our 6,800 through first quarter remains in place. But because we fired a bullish toy barometer and a positive January barometer, we have also issued a 12-month forward S&P 500 price target, which takes us into and through January of 2027. But through the first quarter of this calendar year, we know what midterm fund flows look like. So we held fast to maintaining that 6,800 level expectation. We think the market will stay in and around that number for the bulk of the Q1 period. And wouldn't you guess, right? We're still around 6,800. The next thing we concern ourselves with is essentially staying above the December low. We want to stay above the December low. Typically, if you undercut the December low in the first quarter of a new calendar year, your positive return rate for that calendar year goes from roughly 75% down to about 48%, right? It becomes a toss-up. It's 50-50 essentially, right? So that's the only other thing really in play at this time so far as projecting out the full calendar year. But either way, the toy barometer and January barometer carry significant weight in overall performance, right? We did undercut the December low last year, right? In 2025, we undercut the December low, but we still got a double digit. We still had a positive return, let alone a double digit return for the year. Part of that is the January barometer was also positive, right? So you get the two bullish signals from the toy barometer and the January barometer, you're still likely to have a good year. But we still want to keep some flexibility in our modeling, in our outlook regarding the first quarter and potentially undercutting the December low. Having said that, and speaking more to the midterm election year, I had to also post it for y'all, and you're getting it late. This is why I say always subscribe to Phenom Group. Become a contributor member, become a premium member, get access to all of our research reports, all of our data, all of our chronicled reports going all the way back to 2017. We probably have one of the deepest databases when it comes to sell-side macro market research in the industry. So check it out. But within our 2026 Outlook report, I might have gone too far. Maybe I didn't go far enough. Bear with me, humans. Oh, yeah, midterm years. Here it is, midterm years, just one of, and midterm year, Q2 is generally the weak spot. Q3, this is where you buy. This is where you buy. And here's the pre-election or year 3 of a 4-year presidential cycle they call the pre-election year. Why do you want to be buying here? Well, that's what I'll show you. You can look at it that way, or the chart that a lot of you probably seen in my post today. But for our Phenom Group members, this is what I mean. Our 2020, our outlook reports are crucial for planning. Phenom Group members, you saw this and you said to yourself, okay, there's the midterm election date historically going all the way back to 1942. Midterm election date, if you bought, speaking to the index, right, SPY, if you bought the spider on the midterm election date and you held it to June 30th of the next calendar year, so 7 months, right? You hold it for 7 months, every single return is positive historically and double digits. The average is, the median, right? If I kick out the worst performing occurrence and the best performing occurrence, the median gain is 15+% and never a negative return. Midterm election year date to June 30th, 15+%. And you say to yourself, yeah, but there's a first time for it. Right. That's why Vegas is Vegas. All right. That's called betting. That's called gambling, where you really have no odds. Right. This is about the probabilities. People say, well, that's too small of a sample size. In what world is this a clinical study where I can determine the sample size? I don't have X amount of monkeys that I decide to test my drugs on. That's not how you do statistical analysis, quantitative analysis for market occurrences. You can't control this, okay? When people say it, I'm like, I hope you wear a helmet wherever you go. I don't care if you ride a motorcycle. You should wear one walking up and down the street. If that is your response to data, to market analytics, there's something you're missing. There's something that you need more experience. That's a nice way to put it. You need more experience. But never a negative return. It doesn't get any better than that, folks. And so you ask yourself, well, what about from January 1st to the midterm election date? We've got a lot of negative returns. For those of you who are old enough to remember 2022, we were down 18+% in the market, 18+% before the midterm election date. 2002, down 20%. Barely a decline there in 1994 up to the election, but still negative. Talk about choppy, sloppy. I think that was a midterm year. I know 2002 was a midterm year. 2014 was a midterm year. I know 2018 was a midterm year. So was 2022. These are all midterm years. Duh. Anyways. There's another negative one, 23% in 1974, 1970s negative, it's really mixed. It's really mixed. There's a lot of positive returns leading up to the midterm election date. There's a lot of negative returns as well, right? That's not useful for us, right? You got a 50-50 situation going on there. Nothing you can do. Follow price. Follow price, have a game plan, have an outlook, follow the fundamentals. Follow your stochastics, stick to large cap growth, even if it's under pressure. The stuff that's going on with mid cap, small, it's quite unique as well, because these areas of the market generally do not perform well unless we're coming out of a recession. But when you think about why they are performing well, you're getting that additional stimulus, right? Because that's essentially what drives us out of a recession. We get stimulus. So we come out of a recession. Small caps lead out of recessionary bear markets. Why? Because you got that stimulus. We're just getting stimulus without a bear market, without a recession. But it's not changing what we usually do see, which is you get that stimulus, you get small caps performing well. And so let's go look at why I think it's not a good idea to hold yourself prisoner of the moment to this small cap outperformance, this equal weight outperformance, this lesser cap tier outperformance as it relates to large cap growth underperforming. Another concept that I hear talked about quite a bit is, well, there's new leadership. There's a rotation in leadership. Where is small cap leading to? Where are mid caps leading us to? Where's the equal weight leading us to? The markets are down. Shy of the Dow. I mean, the indices are down. S&P's down, NASDAQ's down. That's not leadership doesn't lead us down. It's not leadership. It's a change in performance. You just have different performance than we're used to. You get addicted or even drawn to these kinds of inappropriate terminologies, phrasings, and characteristics, and you lose discipline. It makes you believe, well, there's a new sheriff in town. Maybe I should be owning small caps and mid caps. Folks, they're small caps and mid caps for a reason. It's an index for a reason. That's where they stay. They don't grow. You don't get the share price performance, but for a window of time. And if you think that you're going to time that window, you've already started down a path of bad discipline. And I see a lot of people, no, we need to be in the areas of the market that are working. You don't have to be. You can be while breaking discipline. You know what the hardest thing to do as an investor is? Break discipline and then fix it. Get back on track. I'm okay underperforming small caps. I'm okay underperforming mid caps. Because I'm not going to lose discipline for a prisoner of the moment situation. This is not going to survive very long. And we had the same discussion last year. The same discussion. How is it happening at this same time of year? Well, guess what? Small caps tend to outperform large caps from December through February of the new calendar year. That's the historic fund flow schedule. Here we are again, December through February of a new year. Guess what's outperforming? Because the fund flows are scheduled that way. We just get a kicker, right? The outperformance magnitude is that much greater than we're used to because we get that stimulus effect, right? The puzzle pieces fit. This is how it's supposed to be. Midterm years, right? And we're not doing much different than we otherwise usually do. It's very choppy and sloppy in a midterm, right? This is the path of the average midterm year. You do typically get, on average, a 17.5% correction in a midterm calendar year. You tend to get choppy, sloppy price action in a midterm calendar year. So fund flows are working. This is not seasonality. This is how the fund flows are scheduled. And by the way, if you look closely, this is a lower low than in here. Now, I wouldn't anticipate these analogs, if you will, these typical or average price path for the 4-year presidential cycle, they'll deviate, right? We are actually worse than the average, right? That's why our performance in the 2026 midterm election year is worse than the average. We're down here, it's up there, showing positive gains at this point in the calendar year for a midterm year. We're just worse. We can all of a sudden surge and be up here and outperform the average midterm calendar year. Right? So don't use them for precision and exactness. Use them as a guide, We can get off the path. We can be on the path, but just to a different magnitude as we are this year. Or we can have hiccups like we did last year in a post-election year. We deviated greatly from the typical post-election year. But then we got back on track. Here I wanted to show also that the Russell 2000 and Russell 1000 index, right? Now, here is the presidential election pattern. Here is the second presidential year. And wouldn't you know it, this time of year, the start of the second presidential year or midterm year, you tend to see the Russell 2000 outperform up to about this point. I'd say that's February. Here we are, outperforming to this point. It's perfect. Look what happens to the Russell 2000 relative to the Russell 1000 after. Do you really want to be chasing small cap? I'm not saying don't, just saying be aware. If you don't know your history, you might be doomed to repeat history. Why might this play out this way? Why do I think it will, even if not to the same degree of the chart that we just showed? Look at the earnings trend. Everybody's talking about the growth, right? The growth in small cap earnings finally here. Looking at last quarter, previous 62% earnings growth, 41% in Q4, expecting Q1 33%, 27%, 26.9%. Anybody see the numbers going lower and lower? It's called deceleration. What do you think is going to happen in 2027? Look at how high these comps are. You think we're going to comp to that in 2027? What are we pricing here in the first half of the year, whether it's S&P 500 or the Russell 2000? What are we pricing so far as earnings are concerned? Right? We're pricing 2026 earnings. The full calendar year, we generally price in the first half of the year. When we get to the back half of the year, we're starting to price a degree of 2027's earnings. So what do you see happening here in the back half of the year for small caps? Get it? Right? It fits. It fits. We're putting the puzzle pieces together, and they fit very, very well. NASDAQ, right? And we know NASDAQ is cap weighted. It's a very heavy index. 10 stocks make up some 25%, and another 10 stocks make up the other, 45%. But in a midterm election year, are we seeing anything from the NASDAQ that we otherwise shouldn't be seeing? NASDAQ tends to be the weakest of the large cap indexes in a midterm election year. Tends to be the weakest. It's that concentration. Midterm election year, when people are selling more than they're buying, at least, up to that midterm election day, well, where do they get the cash from, right? If they want to put it other places, right? Generally, those large cap growth stocks, because they're high dollar value stocks. And it has the greatest concentration in the NASDAQ. So the NASDAQ is going to suffer. You see it already here this year. So is this anything unusual happening here in 2026? Not really. So when you hear the narratives about the death of software, right? AI is going to kill software. CapEx is too heavy for these Magnificent Seven companies, right? Last year, if they weren't spending enough, they got dinged. And this year, they're spending too much, they got dinged. Something tells me this has nothing to do with CapEx. It can't work both ways negatively. Help me make sense of that. But if that's jammed down your eardrums every single day from the financial media, you're going to have a tendency to believe that's what's going on, when the data I'm showing you throughout history tells you this is what's supposed to happen. And those narratives are probably going to be a distraction from you taking advantage of the value opportunity that's being presented from the devaluation and multiple compression in technology and software, the Magnificent Seven, even the S&P 500, which is now trading at 21.9. Well, that's too high, Seth. Multiples expand over time. In the trailing 5-year period, this is the first time in history that we've held a 20 times average 5-year trailing PE ratio. First time in history. You know why it's the first time in history? Because multiples expand over time. Eventually, we're going to be saying this is the first, 5-year trailing PE of 25 times. It's just a matter of when we say that. Not if we're going to say that, but when. So there's nothing unusual happening here. The only thing that's unusual is the bifurcation in the markets. And I think fiscal dominance with this new fiscal package, the OBBBA that we voted to pass last year, is lending itself towards this unusually strong outperformance at this time of year. Small caps equal weight, mid caps outperforming large caps growth, tech, the Qs. You just have to know what to do based on the preponderance of the evidence before you. This happened, this did, this kind of drawdown in tech, this kind of drawdown in internet, this kind of drawdown in software occurred during the dot-com period also. During the dot-com period, internet stocks had 3 separate corrections of greater than 39%. Internet. Same thing with AI, right? The AI stocks are getting hit pretty heavily. The hyperscalers, Microsoft is down 30+% from its all-time high. Apple's in another correction. Google's in another correction. Tesla's in another correction. The software sector industry ETF, IGV, is in a bear market. Again, this is textbook. People don't know. So they lean into narratives. Narratives reinforce the visceral response, which is to shoot first and ask questions later. Hit the sell button, and I'll just come back when the dust is clear. All you're going to do is cost yourself opportunity, otherwise known as opportunity cost. So when people, complain, Seth, all you do is, you're permeable. You're always talking about buying the dip, That's what my stochastics say. That's what history says. I follow history. I obey. You lean into the greater probabilities. More often than not, you're going to be rewarded. And I don't want to miss a single tick. That's why I came into this year cash heavy, so that I don't have to miss a single tick. I bought each and every dollar on the way down in Apple last week. Every single dollar increment lower. I've done that the same way in Meta last week. Every dollar increment lower. These stocks are going down because investors don't have certainty. They are uncomfortable, and it's the narratives that are making them uncomfortable. It's not the fundamentals. They just told you fundamentals remain robust. The earnings results just told you fundamentals remain robust. So there can only be one thing you're actually responding to: your emotions. I'm not going to sit here and judge you right or wrong for doing that, right? You're the one who has to, go to bed at night with those decisions that you make. So it's all up to you. Here is that chart. Down 39%, down 50%, 67%. Internet services, S&P 1500 internet services, 1995 to 2000. These are all before the dot-com bubble crash. NASDAQ, the only one going down. The summation index for the NASDAQ is the only one downtrending. Small caps uptrending. Small caps, not something I've seen before. Not to this degree. Not to this degree. Usually, the NASDAQ is going down, everything's going down. Hasn't been that way. How much longer can investors hold on to this visceral fear, seeing that earnings continue to trend higher? That's the open question. So when I posted the chart here of that midterm election date, if you buy there, this is what I mean by the comments. This is what people do to themselves. Solid data, but the sample size is thin. Only 20 midterms since 1942. Oh, I'm sorry. I should have produced more midterm years. These people are walking amongst us. I promise you, they're walking amongst us. Now do 6-month returns leading up to midterms. I'm guessing is one of the weakest periods historically. Say it nice, ask me nicely. Does it hurt you to be polite? Does it hurt you to be polite? Jeez, what is wrong with people? All streaks come to an end. Who cares? Yeah, and I agree. I agree. They do. What does that have to do with investing? I mean, this is what you deal with in social media. Like, it's so bad. It's so bad. And I try to, kind of narrate or annotate what we discussed here in this chart. The high-low logic index here for the NYSE gets above, that 1.6 level here at the beginning of 2018, and we had a 13% correction. It got well above it here, and we had a 20% bear market in the fourth quarter of that year. We had a big signal here going into the fourth quarter of 2019. We didn't see, and this is what I mean by the high-low logic index is not causal. It's conditional. It's a condition. It's telling you there's an issue. Think of it as a symptom, right? You start sneezing or sniffling, you might be getting a cold, right? The high-low logic index readings, as elevated as they are telling you there's a symptom here in the market that could lead to something, more nefarious in price action down the road. 2022, early. Well, we were already above 1.6 here, right at the start of the calendar year, right above 1.6. So we had a condition, we had a symptom. Symptom got worse, the condition got worse, and we know what happened in 2022. Right? This didn't cause the market to express bear market conditions in 2022, but you get a catalyst, and the conditions are already fragile in the market, and you can exacerbate a downside move, which we did with a 25% peak to trough move in 2022. So, all right, I think we've pretty much had enough of that. Again, hope you enjoyed this podcast and learned something new. Maybe you didn't. But tune in for our next podcast. And if you don't receive our weekly macro market research reports, consider subscribing at phenomgroup.com to our contributor membership. It's only $29.99 a month, or our premium membership, which is $84.99 a month. It gives you a lot more access. It gives you all of our trade alerts throughout the course of the week, month, quarter, and year. With that, enjoy your extended weekend with President's Day tomorrow, and we'll see you back here next time.